Hey everyone, and welcome. Have you ever looked at a company's financial report and just felt completely lost? Like you're trying to read a language you've never seen before? Well, today, we are going to crack that code. We are going to demystify the two most important financial statements that really tell a company's entire story.
So the big question is, how do you actually read a company's financial story? Because, that's exactly what it is. It's a story, just told through numbers. And believe it or not, every single company has one. By the end of this, you're going to know exactly how to read it.
The easiest way to get your head around this is with a really simple analogy. Think of it like this. One story is like a photograph, a single snapshot, frozen in time. That's your balance sheet. It tells you what a company owns and what it owes at one specific moment. The other story? Well, that's the movie. It shows you all the action over a period of time. That's the income statement, and it tells you how the company actually performed. Did it make money or did it lose?
All right, so let's start with the photograph, the balance sheet. You can almost think of it as a company's financial selfie. It gives us this really clear, static picture of its financial health on one particular day. It shows us exactly what it has and exactly what it owes.
Now, right at the heart of the balance sheet is this super simple but incredibly powerful equation. Assets equal liabilities plus net worth. And the number one thing you have to remember is that it must always balance. Both sides of this equation have to be perfectly equal, right down to the very last penny. No exceptions.
So what in the world is net worth? You'll also hear it called equity. Just think of it like this. If a company were to sell off everything it owns, all its assets, and then pay back every single one of its debts, the net worth is what's left over for the owners. It's their actual stake in the company.
Let's break that down just a little bit more. So you've got your assets. That's all the good stuff the company controls. We're talking cash in the bank, inventory on the shelves, equipment on the factory floor. Then you've got your liabilities. These are its debts, what it owes to other people, like bank loans or maybe bills it hasn't paid yet. And that leaves us with net worth, which, like we just said, is just what's left when you subtract those liabilities from the assets. It's the part the company truly owns, free and clear.
Okay, so we've got our photograph. Now, let's roll the movie. This is the income statement. It shows us all the action. It's the story of how a company performed over a stretch of time and whether it was actually creating value or maybe losing it. So you see, unlike that static photo from the balance sheet, the income statement is totally dynamic. It doesn't really care about one single moment. It cares about the results over a whole period, a month, a quarter, maybe a full year. It's all about performance and a company's ability to generate real value.
Now, this next part is absolutely crucial for understanding the income statement. It's called the accrual principle. I know it sounds a little technical, but the idea is actually pretty simple. It just means you count revenue when you've earned it, not necessarily when the cash hits your bank account. And the same thing goes for expenses. They get recorded when they happen, not when you actually pay the bill.
Here's a great example. Imagine a restaurant serves 3 different tables one night. Okay, so the first table pays with cash. The second table uses a credit card, so that money won't show up for a couple of days. And the third table is a regular who actually prepaid for their meals at the beginning of the month. Well, under the accrual principle, it doesn't matter how or when they paid. The restaurant counts the revenue from all 3 of those tables that night, because that's when they actually did the work and served the food. Simple, right?
So how does this movie actually play out? Well, it starts right at the top with net sales. That's all the money coming in from what the company sells. From there, you subtract the direct cost of sales, which gives you the gross profit. But the story's not over yet. Then you have to subtract all the other operating expenses, things like marketing, salaries, R&D. Finally, after you account for a few other things like interest and taxes, you get to the famous bottom line, the net result. And that tells you if the company's story for that period had a happy ending, a profit, or, well, a sad one, a loss. There's one other important idea that guides this whole process. It's called the prudence principle. Basically, accounting is pretty conservative. It says you should go ahead and account for any potential losses as soon as you think they might happen. But for profits, you wait. You only record profits when you are absolutely sure you've earned them. It's a way to make sure the financial picture isn't, overly rosy. Okay, so we've seen the photograph, and we have watched the movie. Now for the really cool part. It's time to connect the dots and see how these two stories are actually deeply connected. So think about it for a second. How does all that action from the movie, the profit or the loss from the income statement, how does that actually affect the next photograph we take with the balance sheet? And here it is. This is the big aha moment.
The net results, that bottom line we talked about from the income statement, it doesn't just vanish. It flows directly into the net worth section of the next balance sheet. This is the absolute key that links the two together. So let me say that again, because it's really the main takeaway here. The income statement tells the story of why the net worth on the balance sheet changed. A profit from the movie increases the owner's stake in the next photo, a loss decreases it. The movie perfectly explains the difference between two photographs. So there's no doubt that bottom line tells a really, really important financial story. But as we start to wrap this up, it's worth asking a bigger question. Is it the only story that matters?
Well, there's this really interesting emerging idea called the triple bottom line, and it argues that a company's story isn't just about that financial movie we've been watching. It says that for a company to be truly successful, it should also be reporting on its ecological and its social performance. It suggests a company's true value is about way more than just profit. And that is a great thought to take with you as you start reading all those stories that companies tell.